The Lucid Air is one of the best electric vehicles on the market. However, the company that makes them isn't doing so well. Lucid's stock is down 95% from its all-time high, and it just hit $3.17 a share. At that price, Lucid has a market cap of $7.3 billion, with $4.3 billion of cash and investments and $2 billion of long-term debt. The enterprise value is about $5 billion. The Lucid CFO said that the company's cash and investments should carry it into at least 2025, but that still leaves the company several years away from profitability. Lucid delivered only 6,000 cars in 2023, way below the scale it needs to survive. So Lucid still needs to raise billions of dollars to get to a point where it can generate positive free cash flow. But with such a low stock price, that becomes a problem. The more the stock price falls, the more difficult it is for Lucid to raise capital by selling shares. That's because investors don't want to buy the stock when they know significant share dilution is coming. And based on the current market cap, Lucid probably needs to dilute shareholders by 100% to get the capital it needs to survive. So the lower stock price also causes a vicious cycle. There are some positives. Aston Martin signed a deal to license Lucid's technology, and Saudi Arabia has agreed to purchase 50,000 vehicles over the course of a decade. Lucid's ties with the Saudis is potentially its only chance to avoid bankruptcy. The kingdom is exceptionally wealthy and could in theory take a large equity stake in the company, pay off some debt, and give the company some breathing room while it prepares to launch an SUV next year. But that shouldn't detract from Lucid's precarious position. Free cash flow in 2023 was negative $3.4 billion, almost 6 times annual revenue. Short interest on the stock is over 30%, and the company's bonds trade at just 43 cents on the dollar. That price suggests the bond market sees a substantial chance of a restructuring over the next 2 years. And even those bonds create a problem for Lucid. Why should institutional investors buy Lucid stock when they can potentially get a better and safer return by investing in the company's bonds? Lucid's convertible debt matures in December 2026 at $55 a share, so if Lucid pays it off, bondholders could potentially get a 150% return. For stock investors, however, there are simply too many negatives and not enough positives. But these are my personal opinions, not financial advice, and I hold no position in Lucid stock. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.